right? I need you to stop whatever you're doing and listen closely. Because what I'm about to share with you is the kind of thing that most Australians on the age pension simply don't find out about until the damage is already done. In the last 12 months, the Australian government has quietly made two separate changes to something called the Deeming rate. Two increases, back to back, after 5 years of absolutely nothing moving. And the result? Hundreds of thousands of pensioners across this country have seen their fortnightly Centrelink payments shrink, some by a little, some by a lot, without ever receiving a clear, plain English explanation of why. If you're currently receiving the age pension, or if you're approaching retirement age and planning to apply, this video could genuinely save you thousands of dollars. Stick with me, because by the time we're done, you'll know exactly what's changed, exactly how it affects your money, and exactly what you should do today to protect yourself. Let's get into it. Welcome back to Australian Pension Watch, the channel that exists to cut through the Centrelink confusion and give everyday retirees the straight story on what's actually happening with their money. If you're new here, hit that subscribe button now. We cover these kinds of updates every single week, and I promise you, you don't want to miss the next one. Now, let's talk about deeming rates. Because if that phrase means nothing to you right now, that's completely fine. By the end of this video, you'll understand it better than most people, including, I'd argue, a lot of the folks who are supposed to be explaining it to you. Here's the fundamental thing you need to understand about how Centrelink assesses your age pension. Centrelink doesn't actually look at what your savings and investments are truly earning in real life. Instead, they apply what's called a deemed rate of return, meaning they assume your financial assets are generating a certain level of income regardless of what's actually hitting your bank account. Let me say that again because it's genuinely important. Centrelink assumes your money is earning income. They don't check your term deposit rate. They don't ask what interest your savings account is actually paying. They apply a set percentage, the deeming rate, and treat that as your income for pension assessment purposes. So if you've got 100 grand sitting in a savings account earning 0.5% in real life, Centrelink might deem that money to be earning 1.25%. And that assumed income gets counted against your pension entitlement. Now, there are two deeming rates, a lower rate and an upper rate, and which one applies depends on how much you have in financial assets. For a single person, the lower deeming rate currently applies to the first $62,600 of your financial assets. Everything above that threshold gets hit with the upper deeming rate. For couples, that lower rate threshold sits at $103,800 before the upper rate kicks in. These numbers are adjusted periodically, but the rates themselves are what we need to focus on today because those rates just went through two significant jumps. Cast your mind back to early 2020. The pandemic hit. Interest rates around the world were slashed to near zero, and retirees were doing it genuinely tough. In response, the Australian government froze the deeming rates at historic lows. The lower deeming rate sat at 0.25%. The upper rate sat at 2.25%. For 5 years, those rates didn't move, and understandably, hundreds of thousands of Australians built their retirement budgets around that stability. They knew what their pension would be. They planned around it. They felt reasonably that the ground was solid beneath them. Then, in September 2025, the freeze thawed. The lower deeming rate jumped from 0.25% up to 0.75%. The upper rate moved from 2.25% to 2.75%, a 0.5% increase across both rates. Now, a 0.5% doesn't sound catastrophic, but on large amounts of savings, and we'll look at some real numbers in a moment. Even a small percentage shift can translate into a meaningful reduction in your fortnightly pension payment. And here's the part that caught a lot of people completely off guard. Less than 6 months later, in March 2026, the rates were increased again. The lower deeming rate is now sitting at 1.25%. The upper deeming rate is now sitting at 3.25%. Two increases in less than a year, after 5 years of zero movement. If you missed both of those updates, and most people did, you might be sitting there right now wondering why your Centrelink payment looks different to what it used to be. Well, this is very likely a big part of the reason. Let me walk you through what these changes actually look like in practice, because percentages alone don't give you the full picture. Take a single retiree, a homeowner. They've got $300,000 in financial assets, let's say a combination of a savings account and their super in accumulation phase. Under the old frozen deeming rates, Centrelink would have assessed the first $62,600 at 0.25% and the remaining $237,400 at 2.25%. The total deemed income from those assets would have come to roughly $5,490 per year, or around $211 per fortnight. Now, under the current rates, 1.25% on the lower threshold, 3.25% on the upper, that same $300,000 is now deemed to be generating approximately $8,493 per year. That's around $327 per fortnight in deemed income. The difference, an extra $116 in assumed income every fortnight. Income that doesn't actually exist in their bank account, but that Centrelink is treating as real for pension calculation purposes, and every dollar of additional deemed income reduces the pension by 50 cents under the income test. So that same person could be looking at a pension reduction of $58 per fortnight, or roughly $1,500 a year, purely because of an assumed rate of return that may have nothing to do with what their money is actually earning. Now, here's the really significant figure. Before September 2025, a single homeowner could have up to approximately $308,000 in financial assets before losing any pension entitlement under the income test. After the March 2026 increase, that threshold has dropped to around $215,000. That's nearly $93,000 less that you're allowed to have before your pension starts getting trimmed. If your savings sit anywhere between $215,000 and $308,000, and you haven't reviewed your Centrelink assessment recently, there is a very real chance your payment has already been reduced, and you might not have even noticed yet. For couples, the impact is similar in structure. With the upper deeming rate now at 3.25%, combined assets above the lower threshold get assessed much more aggressively than they were just 12 months ago. These are not small symbolic changes. For a lot of Australian pensioners, this is genuinely significant money. Here's the scale of what we're talking about. Estimates suggest that around 460,000 age pensioners were already impacted by the September 2025 rate increase alone. That's nearly 500,000 Australians who saw their payments recalculated, many without a proper understanding of why. The March 2026 increase has pushed that number even higher. Thousands of Australians who were previously receiving a full pension have now crossed into part pension territory. Others who were already on a part pension have seen their payments reduced further, and in some cases, particularly for those with higher levels of savings, the changes have resulted in the pension being cut off entirely. This is not a fringe issue. This affects a huge number of everyday Australian retirees who did the right thing, who saved, who planned, who are careful with their money throughout their working lives, and who are now finding that the goalposts have shifted in a way they weren't expecting. Now look, I want to be fair here. The deeming rate increases didn't happen in a vacuum, and the full picture includes some offsetting changes that are worth understanding. At the same time as the March 2026 deeming rate adjustments came into effect, Centrelink also indexed the age pension itself upward. Single pensioners saw an increase of $22.20 per fortnight in March 2026, bringing the maximum base rate up to $1,200.90 per fortnight. For couples, each partner received an additional $16.70 per fortnight, taking the individual couple rate to $905.20. So yes, the pension base rate went up. And for pensioners with modest savings, say below $100,000 in financial assets, the indexation increase will largely cover any deeming impact, and in many cases, they'll actually be a little better off than before. But here's the catch. The people who tend to be most affected by deeming rate changes are part pensioners, people sitting in the middle with meaningful savings but not enough to be fully self-funded. For those people, the indexation boost may not be enough to offset the reduction caused by the deeming increase. Whether you're better off, worse off, or roughly the same depends entirely on your individual situation. And that's exactly why a personalised review of your Centrelink assessment is so important right now. Here's something that a lot of pensioners don't fully appreciate, and it's actually quite important. The age pension is calculated using two separate tests, the income test and the assets test. Centrelink applies both tests and then pays you based on whichever one gives you the lower pension result. Now, deeming rates only affect the income test. They have no impact on the assets test at all. So if your pension is currently being calculated under the assets test, meaning the value of what you own is the limiting factor, not your assumed income, then these deeming rate changes may not affect your payment at all. But if you're income tested, if it's the income test that's producing the lower result for you, then you are directly in the firing line of these increases. The problem is, many people don't know which test is being applied to them. They receive their Centrelink payment, they trust that it's correct, and they don't go looking for that detail. If you haven't checked your assessment recently, now is absolutely the time to do it. Log into your MyGov account, navigate through to Centrelink, and look at your payment details. It should indicate which test is determining your current payment rate. If you're unsure what you're looking at, ring Centrelink directly on 132,300 and ask them to walk you through your current assessment. You are fully entitled to that explanation, and it costs you nothing. Now, here's a piece of information that most people never hear about until it's too late to take advantage of it, and I want to make sure you're aware of it, because it could be genuinely valuable in certain situations. If you're in the process of selling your home, or if you're planning to sell your principal place of residence in the near future, there is a specific exemption that can work in your favor. When you sell your family home and you intend to purchase, build, or renovate a new home, the proceeds from that sale can be exempt from the assets test for up to 24 months. During that period, those funds won't be counted against you under the assets test. They will be subject to deemed income under the income test, but only at the lower deeming rate, and which currently sits at 1.25%. If you're in the middle of a downsizing process, or if you're relocating and there's a gap between selling one property and settling on another, this exemption can protect a very significant chunk of your finances during that transition window. It's the kind of detail that sits buried in the fine print of Centrelink policy, and it's exactly the sort of thing that a good financial advisor who specializes in retirement planning will know about, and that the average retiree won't find out about unless someone tells them. While we're talking about things that often get overlooked, let's touch on the Commonwealth Seniors Health Card, because deeming rates affect this too. The Seniors Health Card gives eligible Australians access to cheaper prescription medicines under the PBS, as well as a range of other concession benefits. Over the course of a year, that card can easily save you several $100s, sometimes significantly more. But eligibility for the card is determined by an income test. And yes, that income test uses deeming rates to assess your financial assets. If the rate increases have pushed your deemed income above the eligibility threshold, you could lose access to that card. And if you lose it, you lose the concessions that go with it, without necessarily realizing that the deeming rate change was the thing that triggered it. If you hold a Commonwealth Seniors Health Card and you haven't reviewed your eligibility recently, add that to your list of things to check. It's worth a phone call to confirm that your entitlement is still intact. Before I get to the action steps, I want to zoom out for a moment and talk about the bigger picture, because this isn't just about what's happened in the last 12 months. It's about understanding the landscape going forward. Deeming rates were frozen for 5 years. That freeze created a sense of stability, but it also created a false sense of permanence. The back-to-back increases in 2025 and 2026 are a firm reminder that these rates can and do change, and they can change more than once in a short period. At the time of recording, Australia's official cash rate sits at 4.1%. The gap between the deeming rates and the actual cash rate is still significant, meaning the government technically has room to increase deeming rates further if it chooses to. We're not saying that's going to happen, but the lesson of the last 12 months is clear. Don't assume the rates you're being assessed under today will be the rates you're assessed under next year. Stay informed, know your numbers, review your situation regularly, and don't wait for Centrelink to notify you of a change before you go looking. Let me give you a clear picture of who should be most alert following these changes. If you are a single pensioner with financial assets, savings, term deposits, shares, or superannuation in accumulation phase, sitting somewhere between $200,000 and $400,000, you need to review your Centrelink income assessment right now. The threshold changes may have moved you from a full pension to a part pension, or reduced your existing part pension without you being aware of it. If you are a couple with combined financial assets above $103,800, the upper deeming rate now applies to everything above that figure. On significant asset levels, that adds up to a meaningful increase in your assessed income, and a corresponding reduction in your pension entitlement. If you hold a Commonwealth Seniors Health Card, verify that your eligibility hasn't been affected by the higher deemed income figures now being applied to your assets. And if you're approaching retirement age and planning to apply for the age pension in the next year or two, factor these current deeming rates into your projections. Don't plan around figures from 2 or 3 years ago, because the rules have shifted under our feet. All right, here's what I want you to do today. Concrete steps, nothing vague. First, log into your MyGive account and navigate to your Centrelink details. Look at your current payment rate and check which test, income, or assets is determining your pension. If anything looks different to what you were expecting, that's your signal to investigate further. Second, if you're unsure how to read your assessment details, pick up the phone and call Centrelink on 132,300. Ask them to explain exactly how your current payment has been calculated. Ask which deeming rates are being applied to your assets. Ask whether you're income tested or assets tested. You are entitled to all of that information, and it won't cost you a cent. Third, if your financial situation is on the more complex side, if you have a partner, multiple asset types, superannuation in different phases, or you're planning a significant change like selling your home, consider speaking with a financial advisor who specializes in aged care or retirement planning. The cost of a single session could be far outweighed by the pension dollars you'd otherwise lose without knowing what you were entitled to. Fourth, mark a reminder in your calendar to review your Centrelink assessment at least once every 6 months. Deeming rates aren't going to freeze again for another 5 years, at least there's no indication of that. Stay on top of it. The system is complex, we all know that, but complexity without information is where people get hurt financially, and that's exactly what this channel is here to prevent. If this video gave you clarity on something that was foggy before, please hit the like button right now. It helps this information reach more Australians who genuinely need it. Share this with a friend or family member who's on the pension or who's heading toward retirement. There's a real chance they don't know any of this yet. And drop a comment below. I'd genuinely love to hear from you. Did you already know about the deeming rate changes? Did your payment change and you weren't sure why? Have you checked your MyGov assessment recently? Let me know how this is landing for you. Subscribe if you haven't already. We're here every week with practical, current, plain English Centrelink updates because you deserve to understand the system that's meant to be supporting you. Look after your money, look after yourself, and I'll see you in the next one.